Welcome to the Builders Mindset 2024 Q4 and full year earnings report webinar. We're excited you're here today. Thanks for joining us. We're going to dive into the Q4 and full year 2024 public home builders earnings summary that we put out a few weeks ago, probably 2-3 weeks ago. We waited till all the public home builders were done. Year end usually takes a little bit longer. So I think the last one reported in like the middle of March. So the report came out the third week of March. And then we just had to put this together, decide how to do it, how to launch it. And we were going to do a live thing, but the scheduling was very difficult. So we decided, well, we'll do it as a recorded webinar and we'll see how that goes. And so if you're not already subscribed, you can go to the website, amazingmindsets.co, and there'll be a link there, or you can go to the show notes. We'll share those when we send this out and make it available. You can click the link. If you click that link, you'll get automatic access instantly to the summary, which will include an abbreviated version of Q1 because we hadn't started doing these until Q2, Q3, Q4, and the full year. And we hope you sign up, and we're glad you're here. And so let's get into it. I'm going to pull up so we're on the Q4 right now. We're going to give an overall summary real quick on 2024 and Q4. Despite economic pressures, rising mortgage rates, and affordability challenges, 2024 ended up being basically a record year for most public home builders. If you look at the year as a whole, builders leaned into rate buydowns, incentives, and spec home deliveries to keep sales velocity strong and keep deliveries up. Margins compressed throughout the year, but volume held up and in many cases increased. Revenue across the country grew between 5 and 12% year over year, and home deliveries increased between 7 and 15% year over year, depending upon the builder. Builders had to adapt to a tough market, rising costs, rising interest rates, interest rates that just stayed high, well above 6.5% all year. Operational discipline and affordability strategies were key. We'll kind of go into some of that when we go through the builders, what they did, what the individual builders were doing. And so quick high level, what we'll do is I'll talk about, and I'll pull up a slide in a second, that is the builder margins from Q1 to Q4 and the delta between the two. It's not the greatest metric. If you look at any of the reports, they always talk about year over year. There's sometimes a little bit quarter over quarter data, but because of the seasonality of the home building industry, a lot of the statistics just don't play well when you look at, say, Q1 to 2, Q1 to 3. You really have to kind of look at Q1 to Q1. And so what we're going to do is we have 4 builders have already reported for Q1, Lennar, Toll, and KB. Now I want to caveat that the reason they have is because Lennar and KB, they end their fiscal year November 30th. And so their Q1 is December, January, February. So they tend to report in March. We're able to get theirs and watch their reports. And then Toll and KHAV, though, they end their fiscal year, and you can see that I have this sort of over here. If you look at the FY, Toll 10/31, Hovnanian as well 10/31. So their first quarter Q1 is November, December, January. So I make the argument when we're looking at this, and it would be really difficult to do a summary report like this and line all the data up exactly to the same time periods. You just can't because of that variability. But what I would say is that I believe and feel, in my opinion, Lennar and KB, their Q1 is a bit more indicative of the Q1 for the builders that close on 12/31, particularly from a closings and sales perspective, because they really, by the time December rolls around, things have kind of slowed up. Closings can be a little bit elevated for a Lennar or KB, and a Toll and KL for that matter, because there sometimes does tend to be a push of closings in December from the backlog to just get overall numbers. But I think a Lennar and a KB tend to ease off of that because it's really the first month of a quarter and they're years behind them. All the builders that are closing their fiscal year books 12/31 are just pushing to get closings in 12/31. But really high level, so we can kind of paint a picture of like what's coming and what we're feeling, is if we look at Q1 2024 for, let's say, Lennar, their gross margin was 21.8%. Their Q1 2025 gross margin was 18.7. That's a reduction of 3.1%. That's significant. And Wall Street has been hammering them actually for their last 3 quarters on their stock price. And so they've been getting hurt pretty bad. KB, same, like I said, same reporting period. Q1 of 2024 for them to Q5. Q1 was 21.5% gross margin in 2024, and in 2025, 20.2, down 1.3%. KHAV, Hovnanian, Q1 2024, 21.8%, and Q1 25, 18.3%. They were down 3.5 percentage points on their gross margin. Toll, interestingly enough, was sort of the bright spot in the mix of things. Their Q1 2024, 27.5%. Q1 2025 was 28.9%. They were actually up 1.4%. So getting some mixed stuff. As we've talked about, demand is there. It's inherent. It's just a matter of tackling the affordability challenges with interest rates. And then, the terrible tariffs are going to do nothing but, make things a little bit worse. Let's jump over real quick because then we'll dig into the data. I did a little quick sampling here of sort of the top 10 builders so we could look at their margins throughout the course of the year. This is for 2024. And what you'll see is that most of the builders, so let's say like 7 of the top 10, were down from Q1 to Q4, which is kind of interesting. I think builders, were kind of trying to push margins up or maintain them. But as you can see, DR Horton was down 0.5%. Pulte, big one, down 2.1%. NVR down almost 1%. Meritage down a little over 2.5%. KB down 0.7%. Toll was down 1%. As we talked about, like their 28.9 here for Toll. That was same reporting period a year prior was 27.5. So that was an improvement. And then if you kind of watch, they were down a little bit, back up a little bit more, and then down. So from Q1 to Q4, they were down 1%. MI homes down 0.4%. The bright spots in these, what we're seeing here, Lennar up 0.8%, even though, as we said, though, their Q1, so their 21.8 compared to their Q1 25, down 3.1%. So right now, Lennar is at, their Q1 was at 18.7%. Put that in perspective, put that there. But over the year, they were able to maintain and or increase their margins. Taylor Morrison up almost 1%, 0.9%. You see here, done a really good job. Taylor Morrison's done a good job of raising prices strategically to maximize the value and the margin across the country. And then Centric Communities essentially flat, up 0.1%. So kind of a little bit of a mixed bag. It just depends. And I know there's a lot of negativity and a lot of talk about what's going on in the marketplace, and tariffs are not making that any better. So, as we talked about, let's jump into some of the Q4 stats that we want to point out. Now, as we look at this, we tend to do is as the blue is the top performer, the yellow is the lowest performer. And sometimes we'll highlight a little bit of an improvement Q over Q. I would say those are kind of hard to come by from a quarter over quarter perspective at this point in time. But let's run the numbers for Q4 just to kind of show you where we're at in terms of the high numbers. So Lennar, second largest builder by closings in the country, but they took both the net closings and the revenue for Q4 over Horton. I've talked about that in the podcast. Lennar last year closed the gap between them and Lennar in terms of total number of closings, and we'll share some summary data for the whole 2024. So they were the largest. I don't show a lowest performer in closings or revenue because, as a general rule of thumb, as you go down the list, you're going to get smaller. So obviously, United Homes at the bottom here, they're the smallest public home builder. They had 414. They're going to be the smallest. The only thing I think that kind of does sort of stand out a little bit, I would say, is if we look kind of right in this world right here, if you can see where I've highlighted KB, Taylor Morrison, and Toll from a revenue perspective. And we rank these, just so you know, these are ranked by largest builder by closing volume from the prior year. And there might have to be a little bit of adjustments, and we'll look at that when we look at Q4, the full year. But what's interesting to note when you look here in terms of revenue, your 7th, 8th, and 9th largest builder by closings had revenue that was above 6, and in one case above 7. So KB and Taylor Morrison had more revenue than Meritage did, but less closings. It's just a factor of price point, average sales price. So like if we jump over here and you look at column I, so you'll see KB's average sales price was $501,000 compared to Meritage's $395. Meritage's focus is a fair amount more on entry level spec homes. Options are pre-plotted, whereas KB does focus more on that, what they call, BTO, build to order. So they have a higher price point. Same thing with Taylor Morrison. Look at that, $608,000 compared to both KB's and Meritage. So a higher ASP is going to drive that up. And you could see Taylor Morrison, even though they were 7th in closings, they are chomping right at number 5. They're at number 6. They're number 6 from a revenue perspective in Q4. And then Toll at 3.26. If we rank this by revenue, Toll would actually be number 4 in the country, right behind Pulte. So with that said, I don't typically highlight the lowest performer because it just kind of tracks down the way a little bit. I will say here's one other one we can kind of point out that I think is interesting. If you look at Dream Finders, and Dream Finders is actually an interesting one just in terms of the growth that they've had, and I think they're going to continue to have. In terms of their closings for the fourth quarter, they beat MI. They're 11, MI is 10. They beat number 10 in fourth quarter closings, and they beat number 10 and number 9 in terms of revenue. So kind of interesting, in terms of what they're doing. And once again, look at that average selling price, 507. All right, so let's jump into the gross margin for Q4. Top performer gross margin for Q4, Green Brick Partners. If you're out of the West Coast, you may or may not have heard of them. They're based out of Texas. Good, solid builder, really up and coming, well-run organization. Just over 1,000 closings in Q4 with a 34.3% gross margin. And they also take the prize of net income as a percent in terms of after-tax estimates. 18.3%. Really, really solid performing and growing builder. Really looking forward to tracking them in 2025 and seeing how they do, because I think what they're doing to maintain this level of operational efficiency and deliver these margins, I believe is going to set them apart and have them really doing some solid business and really performing well in a tough year of 2025. So Lowest performer on the gross margin front was Beazer Homes at 15.2%. And lowest performer on the net income after tax was Land C. And you can kind of go into, and if you want, I highly recommend everybody, listen to at least 2 or 3 earnings reports a quarter. I'm a big advocate of listening to like one of the top 3 or really 2. I think like if you look at the closings at 22,000 for Lennar and 19,000 for Horton, and when you look at the year, you'll see dramatic as well too. And then number 3 goes to 8,000. So they really, over the last decade, Lennar and Horton have really set themselves apart from a scale perspective. So I highly recommend that each quarter you listen to either a Horton or a Lennar, both if you have time and you can. They're only about an hour, sometimes an hour and 15 minutes. And then cherry pick, 1 or 2 others to listen to, just to keep your finger on the pulse, and then you understand like why things are the way they are, why they are performing the way they are, good, bad, or indifferent. So net income in millions of dollars pre-tax. Lennar, again, they really just had us, even Wall Street did not like their numbers overall. Them is that they're outperforming number 1 and the number 2 spot. They going to be tracking them. I've said this before. I'm calling that by 2030, I believe Lennar is going to surpass DR Horton for most closings in the year in the country. So 2030, I think, will be the year that Lennar does that. But 1.45 $7 billion in pre-tax income, all the way down to Land C, which would make sense, is like they had the lowest net income after tax, so they also had the lowest dollar tax or dollar income pre-tax at $3 million. And okay, so SG&A, we talk about this a fair amount. Sales, general, and administrative expenses. This is kind of like a subset of overall overhead that home builders like track. It typically gets talked about on earnings calls. It's typically shown this way in their SEC filings. Sometimes they'll split this apart a little bit, but you can still use it sometimes on the selling expense and then a general and an administrative expense. But as you can see, so in this case, the lower number is the better. And there can be, and I've talked to people, there's not always an apples to apples comparison, and it can be very difficult because sometimes certain things can be coded a little bit different. So, but you look at Pulte, they run a tight ship when it comes to their SG&A at 4.2%. They have, the lowest right now from how they report it. And then LGI has the highest at 14.7. Not uncommon for LGI to have a very low. They really focus on true first-time home buyers. I mean, like, I don't think it gets any more first time than what LGI does. So they tend to have a lot of upfront sales expense when it comes to getting traffic in from like apartment complexes, getting that traffic nurtured, getting people with low credit scores up. And, I've heard stories that like LGI might nurture buyers for a year before they go under contract because they're trying to help them get their credit score up and get in that place where they can, qualify for their first time home. And but meeting a very, very important need in the market, in terms of home ownership. So my hat's off to them. They do a great job, and excited to see how they navigate this next year with the affordability challenges. So, but as a general rule of thumb, we like to say is the SALT line tends to be about 10%. Not saying that if you're above 10, it's horrible, but I will say if you're below 10, that's good. Like, I mean, generally speaking, is Meritage at 10.8 bad? Absolutely not. They're a solid builder, and they have a very strong realtor program, which feeds into that number, I believe. But I would generally say you want to kind of be in and around that 10 or below range. When you start getting up, let's say like an LGI to 14.7, there should just be a reason for it. It should make sense. You don't want to find yourself 14, 15%, and not have, a reason for it. So, but, kind of solid across the board. Yeah, Beazer was up at 14%, Smith Douglas at 14.9, Landsea 12.5, United Homes at 13.1. Look, even Green Brick, one of the best performers out there, even they were at 10.9%. So it's not the end of the world. Century Communities 11.5, MI Homes at 11. Not the end of the world, but I would generally say, like, if you're over 10 or 11, really definitely if you're over 12, 13 especially, there should be a really good reason, like I described for LGI. It makes sense. They're typically higher than most of the other ones. All right. So average sales price. Once again, these are both blue, and the reason I do both of these in blue, the highest and the lowest, is because it's just a matter of strategy, in my opinion. If your strategy and the market you're in is lower price entry level, then being 324 like United Homes is, and being the lowest in the country for that quarter, that's right where they want to be, and that deserves, in my opinion, it should be commended. Whereas at the same time, Toll is a completely different animal. They're a completely different customer group they're going after. And so they're historically and typically number one, just over $1 million in Q4. And I would say is on the lower end, what you'll see typically is you got, and let's kind of highlight these so you can see it. I would say Smith Douglas, LGI, Century, and Meritage, and Horton. So those 1, 2, 3, 4, 5, 6, those 6 are that I would say are duking it out for sub 4 on the average. They're meeting a need that is very, very important for homeownership. It's that entry level market. And so I say that one's typically a little bit more sort of fun to watch if you like a little competition. Toll usually dominates the upper end of that market from a public builder perspective. All right. Net sales. I typically also don't rank this one because there's just too much closeness in terms of, like, should I say, it tends to rank top to bottom. Why I did highlight Horton, though, is because two reasons. Number one, they were top in sales, even though they were not top in closings and revenue. So they still did maintain top in sales. But I want to point out is, and this will mean a lot more when we get into the full year data in a little bit, but that 1,000 home sales over Lennar, it's not enough. And this is why my prediction that Lennar is going to eventually catch them is Lennar continues to narrow the gap in closings. And as that sales number doesn't outshine Lennar's in a big way relative to where they're at, like, Lennar is just going to continue to keep chipping away at that lead that Horton has, and they're really coming after it, coming for it. So, and then what you'll see here is, generally speaking, I don't think there were any except like this very minor one. If you continue on down the line, it's basically was a bright spot with their 1,747 closings. I think KO's done a really good job, in my opinion, over the last decade to, recraft themselves, reposition themselves. And, there was a time back in the day when I think, like, their stock went to like less than $1. And it was tough, but they've really turned things around. And I think this here for me is a sign of something to come, their sales for Q4. Absorption. Those of you who've listened to the podcast or, watch, this is a big one for me. And I talk about from the health of the economy. I always say that, like, over 3 is really where we want to be. Under 3 is not horrible if there's a strategy to it. And I just happen to be on Taylor at that 2.6. I think Taylor Morrison has a strategy at 2.6. They're historically not the highest absorption builder. They tend to be a bit more strategic about their pricing and what they do with their pricing. And so they tend to have a lower absorption pace, but a higher price. Okay. And that tends to protect their margin a little bit more. Some of the builders, it's really hard to, I can't even get the data. So you'll see there's some NAs there. This is one that not every builder reports on, but generally speaking, like I said, if you're below 3, there should be a reason. Okay. If you're below 2, as we have one yellow there, that's Beezer. That's not the best. I don't feel like anybody wants to be below 2. If you're between 2 and 3, as long as there's a strategic reason, you have a strategy for why you're there, fine. And then 4 is kind of the sweet spot. Over 4 is really also where you want to be. I could pop back over really quick. You'll see the winner was 4.2, Lennar, 4.2. That is number of sales per community per month. Okay. And then you'll see like right behind them was Meritage at 3.9 and then KB at 3.5. KB's doing a really good job with a combination of their spec and built to order that are really helping to keep their sales going. But those are the 3 from a reporting perspective that actually put the number out that are, in my opinion, above, like on the higher end, on above 3, as well as KHAV. That's kind of how they got that 1747. So what you have here is you have these 4 builders that are selling pretty strong from just an overall volume perspective. But then you've got some other ones that are, like I said, Taylor's got their reasons. It's helping their margin. It's doing really well for them. But let's see, that 4.2 at Lennar, I'm going to pop real quick over to Q3. And if you look at Q3 absorption, 5.5. Let's go to Q2, 5.7. And I don't think I did not do for Q1. So, but anyway, so Lennar's all about volume, right? Like in the machine, they call it, they're going to match their sales pace to their starts pace, not their starts pace to the sales pace. They're going to drive what they need to, and you can listen to it on the earnings calls. They talk about it. They will make the adjustments necessary to build through whatever is in their head, whatever is a headwind to them to getting their sales pace. All right, let's talk about the cancellation rate. So cancellation rate, I think it goes without saying, we'll just say is this is the, just the percentage of homes that or contracts that cancel versus written. Obviously, once again, lower is better. That's why we have here is Toll. Makes sense. Like Toll's buyer is a very kind of less, a little bit insulated from, let's say, the affordability and the mortgage issues, probably a higher amount of cash they're coming to table. It's more personalized, their home. I'm pretty sure Toll has some stiff penalties if you're buying a customized home, personalized home, to back out. There's probably some things that, like, if you put $300,000 or $400,000 on a $1 million home, and it's non-refundable because they've started building that home to your specifications, it's a lot harder to walk away from that if that's what you're trying to get away from. Now, LGI, on the other hand, the highest, and they're going to be the highest because of their strategy and the type of builder they are going after that true entry level. So if that buyer puts down $1,000 or $5,000 and mortgage rates change or a job layoff or something, they're going to walk away from that $5,000. So they're going to have a much higher cancellation rate. What's the right number here? This is one where it really doesn't have a right number. It's really more about what you generally see is, I feel, for the most part, the lower you are on the specification level, so the more entry level you are from a buyer perspective that your target consumer group is, the higher your cancellation rate. Generally, the higher you go, the lower your cancellation rate. So, and you can kind of see that from, if you look at Pulte's a little bit higher, let's say, Toll's a little bit higher and nicer, and KB's kind of weird. They're sort of in that sort of entry level, but Meritage they didn't report theirs. I think they reported theirs last quarter though, at 10%. There's also, like I said, there's other things that they can do to move that number around. The harder of a policy they have about non-refundable deposits and how large those deposits are will tend to drive that cancellation rate down. The lower their deposit requirements are and the more lenient they are with giving that back, the higher their cancellation rates are going to be. Okay. All right. Number of employees doesn't mean a whole lot in the grand scheme of things, except I do say, when you look down the list and you see that somebody has more employees than a company doing more closings than them, that might make you go, and think about that from an operational efficiency and from their sales, general, and administrative expenses. It just kind of kind of speaks to some things. But what I like to do though is I like to take that number and I like to put it over and compare it to the number of closings they have per full-time employee as reported on the finance websites, and then the revenue that they generate per employee. And I think those kind of like stack things up a little bit better, because obviously United Homes with 414 closings is going to have less employees than a D.R. Horton. But how do they leverage that employees from an efficiency standpoint? So Horton has 5.16 closings per employee annualized, and United Homes has 8.45. So I would say again, here, higher the number. To me, it's a telling sign of you're maximizing output with your inputs, right? And so the winner, like in this quarter, was Smith Douglas at 9.01. But I will say, if you look at some of the solid performers in this market, what you've got is those above 7, in my opinion, are the ones that have really kind of figured some things out. You have an easier options program. I believe you can have a smaller purchasing department. You have plan repeatability. You can have a smaller purchasing department and a smaller, starts coordination department or planning plan approval department. You can probably have your superintendents carry more homes, and therefore you can have less, construction teams. So there are things that you can do. And for me, if you're above 7, you're doing great, honestly. If you're above 6, I think you're doing really well. You start to get below kind of 5, and I would say, hey, kind of sort of ask yourself. Now, Toll is a good example. They're typically one of the lower ones. So they and KHAV are the lowest 2 this year. Toll makes sense to me because Toll is, they have lots of plans, lots of back end work, lots of their system and the way they build houses and the types of houses they build. It's going to take more labor to build one of their higher end homes. KHAV, not quite so sure here. I could say that, generally the less you have, the less closings you have, the harder it is to scale. But I mean, that's hard to say when you come down here and you look at, say, Smith Douglas with 9 closings per employee, United Homes with 8.5 per employee, Lancey's 6 3/4, and Green Brick with 6.27. So doesn't always track the same, the revenue per employee, because as I said, it does tie into the price that you're charging, what's your average selling price. So, when you look at, say, revenue is, let me see, is that, so revenue per employee, we've got Beazer coming in at the lowest. And, part of that ties back into how many homes we're selling in that quarter and how many employees, as well as what's that average sales price, in that given quarter. So when you look at a KHAV, let's say, who has lower closings per employee, but higher revenue per employee than, say, a Beazer, what you've got is they've got a slightly higher average sales price at 531 compared to Beazer's 508. Okay. So that's most likely what's going on there. And then when we compare, let's say you got your Smith Douglas, which has your highest number of closings compared to Dreamfinders, who has your highest revenue per closing. Once again, look what we have here. So look at that revenue, $507,000 average sales price for Dreamfinders, $344 for Smith Douglas. So Smith Douglas takes it for number per employee, but they're a little further. And those are the better if you're, if it comes. And so we'll go and look at. So we go. If you're over 3 million, in my opinion, that's running pretty operationally efficient. So this is why I would say I'm still bullish and optimistic on home building in general. I think these builders here, you've got Pulte, Meritage, KB, Taylor Morrison, Century, Dreamfinders, Green Brick, Smith Douglas, and Lancey, all generating well over $3 million of revenue per employee. Cycle time is a really, really tough one. Very few builders actually give a number. Some of them talk about improvements over prior quarters or prior year. As you see, like DR Horton said improved. I think this is Toll said it was a little bit lower. These are good things. And so some of these MI said lower year over year. You've only got a couple of them that actually plug in a number. Hobbs said 150, so 5 months there. But you've got Lennar's talking 138, which is about 4.5 months. And then you got your Meritage and your Century, which are pushing really at 4 months. And that's where they want to be. You definitely want to be under 6 months as a production home builder. You really want to try to be under 5. The closer to 4 you get, the better. A wise person once said to me, nothing good happens between starting a home and closing a home. So we want to get it done as fast as possible. So the longer it takes to build a house, for those of you who are not familiar with high volume production builder mentality and how we do things, you think, oh, quick is cheap. I'm not going to say that. That is not the case. We all say, like, what is it? Cheap, fast, and good. You can only have 2 of them. I don't think that's the case in home building. I think relative, and I don't like the word cheap. You can have one of the most relatively affordable homes. It can be built really fast, and it can be a very high quality home. And I think there's a lot of builders on this list here that provide all of those. And it's not hard to do. And look, I've seen some very expensive custom homes that I wouldn't buy. Probably more custom homes that I walk are of worse quality than are good. And the ones that are worse quality than good, they're worse than anybody, most of the homes of the folks building on this list here. So all right, so let's jump over to the 2024. We'll look at the full year real quick and take a quick peek at that. So 2024, the whole year didn't really, I guess maybe we can highlight these as we go along. So no question, as we said, Horton is still number one, 93,600 closings, and Lennar at 80. They closed the gap over the prior year, and that's interesting. We have some data we can kind of share on that, but you can look that up as well too. But then the thing I want to point out, when you look at them, those two compared to everybody else, Pulte is the number 3 builder in the country, public builder, and builder in general, and they are 31,000 homes compared to Lennar's 80. If you do rough math, we talk about closings. So we just say 31,219 divide 80 to 10. About 39% of the closings of Lennar from a numbers perspective. Look at that. And then the drop keeps going. And you get to 22 for NVR, which that's another drop over the 31,219 for Pulte. Now we're 73% here. And then you can even see like Meritage is going to be another drop. And we'll do that one real quick, because then you'll see then things start to sort of settle out. So if you compare Meritage is 15,000 to NVR's 22,836. Now we're another 68% of that. And now you start to see, now you got this chunk in here where we're sort of in that 15. You got kind of the over 10s, and then you've got the hovering at 10s. Now you got your 6s, and then you got your under 5s, right? So that's general. Now here's the interesting thing, though. Look at this. Now that 2030 that I said, when I believe Lennar will have more closings than DR Horton, we'll take that to the bank. In my opinion, I'll put money on that. But look at the revenue, and look how close the revenue is. And what does that come from? Look, once again, average sales price. Lennar, even though Lennar has kind of that everything's included, their price tends to be a little bit higher, but it's supposed to have the features that people want, and they're included in the base house price. But this is the average total selling price. But if we look at that 423 and we divide the 378, basically Lennar's average sales price is almost 12% higher than DR Horton's. And so that's where you're getting that really close 36.8 billion to 35.4 billion. Really, really close in terms of that. So now as we jump over to the gross margin, what we'll do is we'll go and we'll look for who was number one. Looks like it's 20. There's 27. Oh, there we go. Of course, Green Brick at 33.8. Let's go ahead and highlight that in blue. And then what was the lowest? There's 19.9. Yeah, looks like we got 19.9 for the full year. And I forget exactly off the top of my head, but Landsea, I think you remember, had the lowest in Q4. They had some adjustment and a write down. I think they took a hit on an asset, and that's why they were there. So, but you're looking at gross margins ranging from just under 20% to 33.8 for the whole year. Net income in millions. So we're going to say, not going to be surprised, right? This is going to be most likely Horton. Lennar could have given him a run for the money in this one, and then if we go down to the lowest, not surprising that from a, and so this is why it's funny. I do the dollars here, but ever margin as a percent and net income after tax as a percent to me are a little bit more sign of the health and well-being of a company, because percentages kind of like take, that pushes aside the overall volume perspective. This is kind of like a measure of like, how well are you performing with what you're giving? And so you've got Landsea again, kind of struggling down there, but so, and we didn't talk about this in the last one, and I know there's a lot of like belief that home builders are just like big greedy developers and make a ton of money. Let me just say something right here. It's a good time for me to point this out. Wall Street likes growth. They want growth in margins. They want growth in revenue. They want growth in units sold. And so if you're looking at a Starbucks or a Target mentality, a lot of times on those earnings calls, if you listen to them, they're going to talk about, did you have same store sales improvement, or did you have more sales because you opened new stores? Okay, those are the two things that tend to move your revenue and your volume, right? Same store sales improvement. That's the equivalent. If we go back to, we talked about Lennar had 4.2 sales per community per month and Q4, and in Q3 they had 5.5 and 5.7 in Q2. Okay, that is the equivalent of Starbucks saying, hey, we sold, we had more sales per month in our locations on average than we did last year. They had promotions and they sold more. Okay, here's the challenging thing though, when you compare those two models, like home building to Starbucks. Starbucks builds a store and they put it on the corner, across the corner from the other one, because they're going to get traffic going in both directions. And so that was kind of a joke, but not really a joke, because I've seen it before. But when Starbucks wants to increase their sales, just like Lennar did there, per store, because a community for a builder is a store. When they want to do that, all they have to do is they run certain promotions and ads. If they work, they work. If they don't, they don't. It's not always guaranteed. But when they sell and it does work, all they've got to do is buy more coffee beans. They just got to buy more inventory of whatever it is they're selling and promoting and going out the door. If I have a community and I've got 200 lots and I increase my sales in that given community on a per month basis, there's no more inventory I can buy for that community. And so that same store sales increase can be detrimental for home builders. It can get too high, because then they go through and they run through that. Starbucks, they build that store and they can sell out of that store for 10, 20 years. They might have to remodel it here or there or whatnot. But when those 200 home sites are done, I can't order more coffee beans and sell more coffee beans at that community. And I can't like use that sales office even, or those model homes. They have a lifespan for a home builder of typically 2 to 4 years. Just depends on where you're at in the size of the community. But I would say the average is 3, 150 lots per community, 50 sales and closings per year. That it's got a lifespan of 3. Now I got to go build another store to stay even. When Starbucks goes and builds another store, now they have another store. Now their revenue goes up. So same store sales increasing in home builders will be detrimental to the long term, because when that community closes, that store's closed. They can't order more inventory. And so they're kind of have this finite. So it's like when you look at retail increasing sales per store Okay, that's going to run us out of those lots in that community faster. And that might be the strategy. And Lennar did that a fair, most of the builders did that, I want to say, in Q3. They did that in a big way in Q3 because they were struggling to get those new stores open. And then to increase your store count, here's why I tell you, don't always jump the gun and get, angry at builders for this net income after tax. For a home builder to get a new store, they don't just build a model home. They go buy 150 lots, give or take, and then they put a model home in that community. So they bought all of this land for the most part. They've developed that land. It's a huge capital investment that, in my opinion, rivals the Starbucks that when they see your models open, then they open a store right up the road that might be, a repurposed, photomat or something like that. So they might remodel something. But so it takes a lot of capital to be a home builder, and then the warranty on a home in most markets, depending upon where you're at, is anywhere from, I want to say, like, let's call it 8 to 10 years on a structural aspect of things. So, builders need to maintain this net income so they can have positive cash flow to reinvest and keep moving the machine forward. I know legacy, we always think about like these big golf course communities where there's thousands of homes. We just don't, not every builder has access to that in all markets. And so this number here is key. And what I would say, this number ideally, well, this number should be over 10, my opinion. Should always be over 10. Ideally, you want to be over 12. And so if we show all the ones that are over 10, say you got a good number of them. Okay. So is that 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 out of the 19 that we have here, right? So that's good. Is 9.5 horrible? Nope. 7.6 horrible? No, not exactly. Strategy, right? Like, I mean, look at Amazon. And so, but generally speaking, I think you want to try to be at 10% or better. And if you can do that, good. So, all right. So SG&A for the year, we talked about this. Let's go ahead and find who was the best. I think we still got Pulte coming in at number 1. We're going to highlight them, see if anybody's. And then is LGI once again. So see, this is kind of consistent, a theme, not saying it doesn't break from this. But once again, you want to try to be like builders are performing well. They're performing well. They're selling well. They're managing their resources well. So this is why I'm still optimistic about 2025, even with the tariff tantrums that are going on right now, because it's just so. Average sales price per community. Let's go over that. We'll see. Once again, not surprising. There's toll. Who got low? 378. Let's see that. There's 365. There we go. We're at 324 again with United Homes Group, if I got that right. As we said, we mark both of those in blue because they're just different business strategies. And there you have it. Net sales. Here's kind of another interesting one that I find is if you look at the net sales differential, this is what I'm going to keep going back to this Horton and Lennar situation, right? So Horton and Lennar. So let's look at the net sales difference for the year. 86,561 minus 76,951. Okay. So there's a DR Horton sold 9,600 houses more than Lennar, but they closed 13,000 more. That I don't like if I'm Horton in terms of maintaining my position. Okay. What I also don't like, just in general, is I don't like these numbers being so far off of these closing numbers, right? Because now I got to build into that backlog. This is the full year. So this kind of tells me that we do have a little bit of a softening market. I don't believe, and I've talked about this, I don't think it's because of demand. I think it's because of affordability and the ability of builders to deliver homes at the price point that buyers can make work for them from a monthly payment perspective. So if you look a little bit more here, and I might probably do this next year, is I might add in let's go and say, what is the sales as a percent of the closings? And so we see what that is. And then we suggest Okay, we got the, oh, we can check that off. We'll go, okay, but then let's go and let's just change that to a percentage, and let's drop the down. Okay, so I think you could look at that as sort of another thing to just sort of, in my opinion, to see the health of maintenance of your builder size. And I would almost always say, like, probably better than 95% is solid where you want to be. You probably don't want to be below 95% because I think that might be a little bit of a bigger hole to dig out of. And if you're at 100, 105, you're at 98, you're in a good place. That's sort of, but I don't know that anybody really measures this, and I think I just made it up, so I'm going to leave it here. And so we'll kind of add it into next year's and kind of talk about what that looks like. I think this works year over year, but I don't think it'll work quarter over quarter because I think closings are different than, kind of sales perspective. So we'll do it on a yearly basis. All right, so net sales, like we said, I don't see anything out of the ordinary here other than that I pointed out on Horton Lennar, in terms of anybody selling more than somebody above them. Looks like it's tracking the same way. Number of employees, it is what it is. And so let's look at closings per employee. Let's see who had that. I think it was, yes, Meritage did take it for the year. And on the lower end for the year, there's 3.8, 3.6, 3.2. So KHAV again, 3.2 closings per employee. And then let's see where we land in terms of revenue. So we'll look at the two of these together. There's 3.4. It's actually fun doing this together. I might do this every year when we do this, kind of like do this together. Looks like 3.4 for Meritage is number one for revenue per employee. And is KHAV going to take that as well for the low end? I get that right. 1.59. Yep. They sure did. And we'll put that there. Now, I don't know for sure, but I always like to say NVR. I don't know too much about NVR. I should probably do a little more research. But my understanding is NVR is one of the builders that does a good job if you're from a supply chain perspective and you like buying your material direct. They buy plumbing fixtures direct from the distributor, and they give them to the plumber. I often wonder if their employee count is higher because they have a heavier estimating and a purchasing team, and if that's what kind of like drives this piece a little bit. Maybe that's the case, and then they're still, kind of happy with how things work out for them. I could do a whole series of podcasts on, turnkey versus, estimating, and Ken Pinto and I could we could dialogue about that for probably days on end, and we would agree on some things and probably disagree on some things. But it's interesting is that I wonder if that has something into it. But at the end of the day, they still have solid gross and net margins. So there you have it. That is the 2024 window. And as we said, these are still numbers, record numbers. D.R. Horton, their 93,000 closings was 3.1% year over year. Lennar's 80 was 9.75% increase year over year. And Pulte's 31 was a 9.1% increase year over year. Horton's revenue, these are some of these things were just really they still had top in class improvements year over year. The gross margins full year were 21 to 33.8%. If you count green brick, if you take them out, they went up to 28%, still solid. And net margins, you got Pulte at 17.2, green brick at 18.2, NVR at 16.3. 12+%, as I said, still really remains the gold standard. 10 and above is okay. But if you're below 10, you're going to struggle, I think, with cash flow in the long run if you stay there too long. Sales efficiency, just and closings efficiency, I should say, is Meritage at 8.5 closings per employee is just best in class. They run a really streamlined, efficient program over there. And you've got Smith Douglas kind of right behind them with their 7.3, running a good outfit, and United doing really well with theirs. And notable mention is Century. They also do a good job. So does Horton with that. So, 2024 proved the resiliency of public home builders. I mean, they literally they have been battling with affordability and interest rates for since the beginning of 2023. Actually, October 2022 is when rates first hit 7, and they figured it out pretty quick and had a lot of headwinds, but they still delivered record results, maintained profitability through tight operations, smart strategy. And I think if you look at the metrics, you'll find a lot of these builders who are going a little bit more streamlined, a little bit more efficient, are the builders that, not saying like the Dream Finders and the KBs that are doing kind of built to orders a little more, kind of personalized, aren't doing solid. But when you look at some of these builders who are really streamlining the operations, it's starting to pay off for them in a big way. It's helping with, they're leaning into trying to get quicker build cycles so they can get faster turns, trying to grow their communities so they can get a bigger footprint to, have more available options for folks. Anything to keep sales moving. Go back to that Starbucks example, right? Starbucks, I've seen it within a mile. I've seen them have a Starbucks on both sides of the street, and that's for convenience, right? And so that's kind of also what an additional community does. Maybe the one that's available kind of in that area isn't ideal, but the more offerings that they have that they can cash flow and manage, the better off they're going to be in total sales. I expect flat to slightly down performance for 2025. I'm predicting plus or minus 2.5% in terms of overall. In the publics, I see most of them kind of being flat to just a little up, 0 to plus 2.5%. If we go wider, if you're looking in your market, I think your market's probably going to be in the plus or minus 2.5%. And within that, some of the builders in your market will be up a little, some will be down a little, some will be flat. So it'll be interesting to, I think, but if you look at the land pipeline that's coming, 2026 is big. The bidding cycle for vertical construction, bricks and sticks, is going to really start picking up here as we roll through Q2 and into Q3. Look, those land assets with inherent demand where it is, this is interesting times, and I'm really excited to watch it because it's not like we don't have people that want to buy the houses. So builders just got to figure it out. They've got the assets in land that they have to monetize. The only way to really monetize that and make money is to sell homes. But they still have affordability challenges and interest rate problems. So they're going to have to continue to buy those rates down to the 4.99s that they've been doing, and strategize and optimize their operations to make up as much of that incentive as they can. So be ready for the continued hard negotiating on new bids, new communities, price reduction requests at existing communities. And, just remember, July starts our January closings. So if we're going to have a big year in 26 in terms of closings, they really need to start picking up their starts in July of 2025 to get those closings next year that they're forecasting. And you've got folks like, I think Taylor has forecasted 20,000 by 2020. So they've got some growth that they want to put in place. That's it. That's the earnings report in a nutshell. I hope you enjoyed this overview webinar, and we just wanted to make this available for you. If you have follow-up questions, you want to have some dialogue, reach out. We'll make that option available in all the ways that we put this out. This will be free for everybody to look at and to watch, and we'll probably use some AI stuff to kind of do a summary of this webinar too. So if you just want to kind of do a quick cursory review, we'll share that with this as well. And we thank you for watching. We hope you join the community. If you haven't, we've got a couple podcasts that we put out. The Builder's Mindset comes out every week. It's all things builder, mostly kind of sort of operational side of the world of things, not land and finance, really more sales, construction, supply chain, product development. We focus on that and how to perform and be the best in class at that. And then we also have our faith-based podcast, Built on Faith, where we just kind of talk about everything faith-based and how it applies to life and business. So we thank you again for joining us. It's been a special edition of the Builder's Mindset. We really hope you have a wonderful 2025. And if you have cause, feel free to reach out. We'd love to chat with you about what's going on in your marketplace. If you've got any challenges or things where you want questions answered from us, reach out. We'd love to talk to you about what's happening in your market and maybe kind of talk about some ideas of how we can work together to keep this wonderful industry providing a much needed and valuable resource for our country. And that is homeownership for the American dream. With that, have an amazing day, and we appreciate you.